Good morning, good evening to everyone around the world, governors, deputy governors, heads of agencies, distinguished guests. Welcome to this timeless session on COVID-19, supervising the new normal and implications for stablecoins, financial inclusion, financial stability. Under the circumstances, I wish you good health to you and your family. I am Babak Abbaszadeh, CEO of Toronto Centre. And I think most of you know about the Toronto Centre, so I'm going to save some time and not introduce us. These are unprecedented times. As Professor Carmen Reinhard recently said in her speech, this time truly is different. For policymakers, this is a whatever it takes moment for large-scale, outside-the-box fiscal and monetary policies. Recent stablecoin initiatives have highlighted the shortcomings in cross-border payments and access to transaction accounts, and the importance of improving access to financial services, especially for the 1.7 billion people who are globally underbanked. In fact, the 2019 G7 presidency added stablecoin to its agenda in order to examine the risks and opportunities. Remains to be seen whether these will be indeed some solution to the problems we're looking for. Today, we are very fortunate to have such a high caliber speakers and moderators. You have all seen their bios and most of you know them already. I noticed that we have about 50 countries represented, more than 430 participants. I want to just point out that CEYLA, PAZARBASIOGLU, is a member of Toronto Centre's board of directors, so is ADITYA. And TOBIAS is a frequent contributor to our forums. ADITYA may not know this, but we have trademarked him as one of our marquee moderators. And so we're very grateful to that. It is my privilege, as before I pass the floor to ADITYA, to thank our major sponsors, Global Affairs Canada, Swedish CEDA, IMF, Jersey Overseas Aid, and Comic Relief for supporting our mission. Also, I want to make sure that you all use the Q&A function and submit your questions to ADITYA, because he's committed to make sure that as many questions can be addressed as possible. And also want to thank DIETRICH and my team who've done such a superb job of organizing this and other events. And ADITYA, without further ado, my great thanks to you and the panelists. I'm just going to pass it to you now. Thank you.
Thank you, Babak, and good morning, good afternoon, and good evening to everybody. Extraordinary times call for extraordinary panels, and I'm delighted to be moderating this panel of thought leaders on the complex intersection of topics covering financial stability, financial access, and financial technology. As an aside, we are all getting used to remote working techniques, so let me apologize in advance for any glitches that I may cause directly or indirectly in the course of this conversation. But coming back to the topic, to better provide context to the discussions, we have divided our session into two parts. In the first part, we will cover the implications of the COVID-19 health crisis for the global economy and the financial system and the policy response. And in the second part, we will drill down to the potential of digital payments in general and stablecoins in particular to facilitate commerce and finance in the new world. And just so that we are all on the same page, we will use the definition of stablecoins as put forward by the Financial Stability Board in their most recent report, that a stablecoin is a crypto asset that aims to maintain a stable value relative to a specified asset or a pool of a basket of assets. A stable coin arrangement is one that combines a range of functions to provide an instrument that purports to be used as a means of payment and or a store of value. And finally, a global stable coin is one with the potential reach and adoption across multiple jurisdictions and the potential to achieve substantial volume. Now, for the first round, the policy assessments and responses to the COVID-19, let me first turn to Tobias Adrian, Financial Counsellor to the IMF and Director of the Monetary and Capital Markets Department, to tee up the subject. Tobias, you lead the IMF's assessment of global financial stability in good times and in bad, and play a key role in shaping the financial policy advice that the fund provides to its members. Help us understand what is going on as we face this extraordinary uncertainty about the depth, spread, severity, and duration of this COVID-19 crisis. How do you see it impacting the global economy? The Managing Director, you will recall, said in the plenary remarks yesterday at the spring meetings that exceptional times call for exceptional responses. How are the member jurisdictions tackling this unprecedented crisis, and how do you view these responses?
Yeah, thanks Babak. Thanks Toronto Centre for having me in this wonderful panel. These are extraordinary times and they're extraordinarily challenging. and said there are hundreds of thousands of people that are already sick and the pandemic is continuing to spread. This is, first of all, a medical crisis. And the first order policy response has to be a lockdown. The lockdown, in turn, is generating an economic crisis. Both demand and supply is collapsing around the world. So our forecast just 3 months ago for growth in 2020 globally was above 3%, and it has shifted to now being negative 3%. So it's a 6 percentage point shift in our baseline for 2020. And when you look at the downside risk, so we are looking at downside risk as the 5th percentile of the global growth distribution, that has shifted from a positive 2% to a negative 8%. So 10 percentage point downward shift in downside risks. So that is driven by the huge amount of uncertainty that is currently in the world. And of course, equity implied volatility, for example, as measured by the VIX, which is often used as an indicator of global risk aversion, you know, the VIX has been as high as during the global financial crisis. So this is a historically stressed period also in financial markets. Now, some sectors across the global economy have sold off as much as 2008. For example, airlines, tourism, restaurants, entertainment are all hit as badly as in 2008 already. In general, the sell-off was not as much for 3 reasons. So number one, it is first of all a medical crisis, an economic crisis. It's not a financial crisis that is originating in the financial system. But of course, the financial system is at threat of a financial crisis. Secondly, policy measures have been put into place very rapidly and very aggressively around the world. So we estimate that fiscal policy is about 10% of global GDP, or $8 trillion, right? These are fiscal measures that are consisting primarily of transfers to corporations and to households in order to make sure that cash flows are not collapsing entirely. And the monetary policy response has been extremely aggressive as well, both in advanced economies and in emerging markets. You know, many central banks around the world have cut interest rates, have started asset purchase programs, have injected liquidity aggressively, and have backstopped certain sectors such as corporate bonds in terms of backstop facilities. Banks, of course, are better capitalized than in the 2008 crisis. So the benefits of 10 years of tighter regulation and regulatory reforms are paying off now. We're going into the crisis with more capital and more liquidity in the banking system around the world in pretty much every country. And so these capital and liquidity buffers are there to be used now. And this is indeed what we're seeing. When you look at bank earnings announcements, they show that provisioning is going up sharply because, of course, this crisis is expected to lead to a wave of defaults. Defaults in the corporate sector, in the household sector, and distress in some countries. And this brings me to emerging markets. We have already seen record outflows in terms of capital flows, portfolio flows from emerging markets. And that has been pretty broadly across markets. Of course, there's differentiation across countries, but pretty much all emerging markets and low-income countries have been subject to large outflows. And of course, emerging markets don't always have as much policy space as the advanced economies for either fiscal or monetary action. So that's where institutions like the IMF or the World Bank come in. The IMF has a $1 trillion balance sheet that is deployed aggressively. We have over 100 requests for assistance, right? So out of 190 member countries, more than 100, more than half of our membership has already come to us and asked for assistance. Indeed, earlier this week, we have announced that for the poorest countries, that have already programs. There is a debt moratorium for about 25 countries. And we are working actively on new types of programs. So we announced on Wednesday a new liquidity line that is going to be available for some of the more stable emerging markets. So with that, let me turn back to Aditya.
Thank you, Tobias. Sticking to the theme of extraordinary, CEYLA, you've had extraordinary first-hand experience of dealing with several economic and financial crises in your career at the fund and the bank, and also in a national authority. And this covers emerging markets, low-income countries, and advanced economies. So how different is this? What can policymakers in general and the World Bank Group in particular do to support the financial sector in the wake of the COVID-19 outbreak?
Thank you, Aditya, and thank you, Babak, Toronto Center, and greetings to all. I hope everyone is keeping safe. Aditya, this is a crisis that, like no other. I have not seen this in close to 30 years of my career. It's a human tsunami, like Tobias said. It's unprecedented, both in terms of lives and livelihoods. It's particularly challenging for the developing economies that we work with, as most of them do not have the monetary and fiscal space to deal with this crisis and the ability to put billions of dollars to protect their countries. They have very fragile health systems. Social distancing becomes impossible when you are living in crowded slums, and if you're making your living in the informal sector, and when you don't have any protection or social safety net to disturbance or to the shocks to the income. So the impact on the developing economies, especially the poorer ones, translate directly into increasing poverty. And that's why at the World Bank Group, we have mobilized very quickly. We have a fast-track facility to deal with the health implications of this crisis, working with other multilateral development banks to help countries with systems, with ventilators, with procurement initiatives, and working very closely with WHO and others. So that's a very concrete fast-track facility that we have put in place in almost in record time. And so far, 64 developing countries have been implementing these measures, and we hope to extend this to 100 countries by the end of April. As Tobias also said, the collapse in economic activity, the supply and demand shocks, the commodity prices, the sudden stop in capital flows, remittances, and the movements in goods and services are all impacting households and corporates, especially in the informal sector and the MSMEs. So the social and economic impact of this health crisis is going to be also, has been and will be very important and quite devastating for some of the countries. So we put in place almost 160 billion for over the next 15 months to address the health, economic, and social shocks that many of these countries are facing. So we will assess needs and prioritize the poorest countries, those with a high risk and low capacity, and those in fragile and conflict settings, with a goal to protect the poorest and most vulnerable households, protect jobs and businesses, shorten the time to recovery, and support an economic recovery that is sustainable going forward. For the financial sector, the policy responses to date has mainly focused on providing markets and funding liquidity and supporting affected borrowers and providing regulatory flexibility, with the key objective to preserve the functioning of core financial markets, financial sector resilience, so that the financial sector can continue to intermediate and provide credit to, much needed credit to businesses and households, because this is a time of immense need so that liquidity problems do not turn into solvency problems. But I want to remind everyone that we started this crisis with already record high levels, both in terms of households, both in terms of sovereigns as well as corporates in many of the developing economies. So it is very important that whatever measures are taken are done in a transparent manner with sunset clauses and clear risk-sharing arrangements, because I worry that we end up with a financial crisis after, as we try to deal with the economic consequences of this crisis. I'll stop here.
Thank you, CEYLA, and thank you, CEYLA and Tobias, for laying out this this perspective from the IFIs. And in fact, one of our first questions is about how the IMF and World Bank will work together, and we'll come to that. But I'm giving you a heads up so you can start thinking about this. But let me now turn to DIETRICH. DIETRICH, the Financial Stability Board, was set up in response to the global financial crisis, and just when it was finishing on its reform agenda from that crisis, and possibly hoping to take a short break. It instead is faced with having to double up and deal with this one. In the very short time that has elapsed, how is the FSB responding to these issues? And what assessment has the FSB made of the evolving financial stability vulnerabilities posed by the COVID-19?
Thank you, Aditya, and thank you, Babak, for inviting me to this distinguished panel. Tobias and CEYLA have already used superlatives to describe the impact of COVID-19, and I'm going to add another one from a financial stability perspective, which is that COVID-19 represents the biggest test of the post-crisis financial system to date, and the pandemic constitutes an unprecedented global macroeconomic shock, a shock that is pushing the global economy into a recession of uncertain magnitude and duration, and a shock that has placed the financial system under strain. And here it's the downward revisions of expected economic activity and heightened risk aversion that have led to a major repricing and repositioning global financial markets. And that has involved, as many of the people listening to this panel today know very well, significant, large capital outflows from emerging market economies. Now, I would describe the challenge that the global financial system faces as a dual challenge, on the one hand, of sustaining the flow of credit amongst declining growth and increasing solvency risk on the one hand, and managing heightened financial risks on the other hand. And as a result, the demands on the financial system's capital and liquidity have risen, and this, I think, was very visible in the Dash for Cash episode in March, which triggered decisive and large-scale central bank intervention. Now, the positive news, Tobias mentioned already, is that the global financial system is more resilient and better placed to sustain financing to the real economy as a result of the G20 regulatory reforms coordinated by the FSB in the aftermath of the 2008 global financial crisis. And in particular here, it's the greater resilience of major banks at the core of the financial system, which has allowed the system today largely to absorb rather than amplify the current macroeconomic shock. But maintaining this resilience requires further efforts individually and collectively, and the FSB is working on three fronts to maintain financial stability and sustain the flow of financing to support growth. And let me briefly talk about each of these three areas. First, the FSB is exchanging information daily on policy actions taken by our members in response to COVID-19. We are sharing these daily updates with the 70 countries that are in our regional consultative groups, which include many emerging market and developing countries. Now, this broad sharing of information is helping jurisdictions to respond quickly and consistently. And in the coming weeks and months, it will become increasingly important to assess the impact of the measures taken, compare notes on effectiveness, and in the end, identify what is working best. Second, we are providing risk assessments to inform policy discussions. And a first stage of this risk assessment work has focused on 4 critical nodes in the global financial system. These nodes comprise, first, the ability of the financial system to finance businesses and households, the ability, second, of market participants to obtain US dollar funding, not least in emerging markets. Third, the ability of non-bank financial intermediaries to meet liquidity demands. And finally, the ability of market participants to effectively manage increasing counterparty risks. In the next stage, the FSB will be working to identify and assess the specific vulnerabilities that may materialize during this major global economic downturn in the coming months. And one important issue in this regard is the implications of rapidly growing solvency risks. Third, we are working with our membership and the international standard setting bodies to coordinate global policy responses. And FSB member jurisdictions have taken strong and decisive action in response to COVID-19. These actions have obviously been tailored to individual needs, but they have been underpinned by common principles that the authorities will continue to follow in future to support the real economy, maintain financial stability, and minimize the risk of market fragmentation. And under these principles, authorities will first monitor and share information on a timely basis to assess and address financial stability risks from COVID-19, recognize and use the flexibility built into existing financial standards to support policy responses. Tobias was referring to the fact that it's time to use buffers. Third, seek opportunities to temporarily reduce operational burdens from firms and authorities. Fourth, act consistently with international standard and not roll back reforms or compromise the underlying objectives of existing international standards, quite important. And finally, coordinate the future timely unwinding of the temporary measures taken. So these are the principles that will guide work going forward, and the G20 finance ministers and central bank governors endorsed these principles in their communique earlier this week. I'll stop here.
Thank you, Dietrich, and it's very helpful to hear the message. You ended on the message of international cooperation and coordination, which is probably very much the need of the hour. And now I'm going to start moving down from the 30,000 feet level where we've talked about placing these discussions in context to a little bit more on the issue of innovation and technology. And I'm going to turn to my old colleague, Ross LECKOW. And Ross, when you left the IMF to join the BIS Innovation Hub, the fund lost a key resource on all fintech related issues, but we were reconciled to the fact that this was all for the global good. So we are very keen to hear about the Innovation Hub, its mandate, and more specifically, how its work will contribute to the global response to the pandemic. In your remarks, could you also share with us what the BIS is doing more generally to respond to COVID-19? Thanks.
Well, thank you very much, ADITYA. First of all, let me say what a pleasure it is to be on a panel with such great friends and former fund colleagues. And I'd like to thank the Toronto Centre for inviting me to participate. Maybe I'll start with the Innovation Hub itself and the work that we're doing in this area. You know, I should maybe share with you all that the BIS Innovation Hub is a new initiative of the BIS. Its establishment was announced last June by the BIS, and we're now at the point where we've actually commenced operations. It's based at BIS headquarters in Basel, but with 3 regional centers in Switzerland, Hong Kong, and Singapore, each opened in collaboration with the host central bank in that jurisdiction. And we plan to expand to new centers. The Innovation Hub has a threefold mandate. First of all, to do research around and identify critical trends in financial technology of interest to central banks. Secondly, to establish and foster a network of central bank experts on innovation. And thirdly, to explore the development of new products that make use of new technologies that can actually serve to improve the functioning of the global financial system, and that can be shared as global public goods with the central banking community. The hub is headed by Benoit Cœuré, and he's leading a multidisciplinary team of technologists, lawyers, economists, and regulators. And the team, I should say, is growing very quickly. The range of projects that we're going to be working on initially are quite broad-based, and they deal with different subject areas and technologies, including the development of a RegTech subtech platform in Singapore, the use of distributed ledger technology in the context of trade finance in Hong Kong, and security settlement in Switzerland, and also the use of digital identity as a foundational infrastructure for the provision of financial services in Singapore. You know, while these projects don't address COVID-19 per se, or specifically COVID-19, I think it's important to remember that the work of the hub is focused on helping to define the future of the global financial landscape and to help to realize that vision. And I think one thing this crisis has demonstrated is the importance of new technologies to allow us to function in a world of social distancing, including, I think, society generally, but also in the financial system. And I think that the crisis may therefore have a lasting impact on the shape of the global financial system and may accelerate trends, particularly in digitization, in such areas as banking, domestic and cross-border payments, identity, and regulation and supervision. And the hub is really focused on trying to help identify and facilitate these trends. More generally, the BIS is taking a number of steps to help the international community respond to COVID-19. And I'll just mention a few points. First of all, we're continuing to provide financial services to the central banking community, notwithstanding the challenges of remote working and social distancing. We continue to serve as a preeminent forum for consultation and cooperation between central banks. The regular meetings that we hold that draw together the governors of major central banks are continuing to function, albeit in a virtual format. And we're generating research that examines the implications of the pandemic for the global economy, financial markets, and regulation and supervision. And you can actually find much of this research in two new periodical publications that we've just launched. They're called FSI Briefs and BIS Bulletins. BIS Bulletins are short topical notes that provide insights into current events in banking, markets, and the larger economy. And FSI Briefs are shorter notes that, short notes rather, that look at regulatory and supervisory subjects of topical interest. And if you look at these new publications, you'll see a lot of attention being devoted to the pandemic. One article that I think is of particular interest, which was published by three BIS colleagues, Raphael Auer, John Frost, and Guido Corneli, looks at COVID-19, cash, and the future of payments. And it examines how the pandemic has really sparked public concerns on the potential for physical banknotes in particular to actually transmit the virus. And I think it shows that scientific evidence is demonstrating that this risk is actually low compared to other forms of payments, including credit cards. And that to bolster trust in cash, some central banks are actually actively urging continued acceptance of banknotes and coins, while others are either sterilizing or quarantining banknotes. But in terms of the road ahead, perhaps after the crisis and what this may mean, I think there is the possibility that this may actually spur greater interest in digital currencies, whether it be private or public, with associated implications. Maybe I'll stop there.
Thank you, Ross. Thank you for providing that segue into the next round of our discussions. And what have we learned so far? We've learned that the real economy is under great strain. The financial system is currently resilient, but there are already pockets of vulnerabilities in some emerging markets and developing countries who don't have the space to respond with the policy measures that the other countries are being able to take. That international coordination and cooperation is essential to enable the global financial system to continue to respond in a manner that allows for the continuation of the post-crisis reform agenda to be to remain as the basis of our work going forward. But all of this also means is that the financial system has to be prepared to transform in many ways, particularly the transactional ways. And Ross pointed to how already many changes are, it is forcing us to think about what the new world might look like. So with that, let me move to the second round of our discussion, and let me get back to Tobias. Tobias, you've done a lot of thinking on the broader policy implications of financial innovation, and you've written extensively on stablecoins and digital currencies as well. You're a member of the G7 Stablecoins Working Group, which has been very emphatic that no global stablecoin project should begin unless the legal, regulatory, and oversight challenges have been adequately addressed. I know that the other speakers will cover some of these issues with more specifics, but could you lay the ground for us by taking us through whether payment innovations, particularly stablecoins, have had any major impact on payment and transactional ecosystem yet? Also, a particularly vexing issue is that of cross-border payments, which continue to be costly and difficult despite a multitude of projects aimed at addressing this. Can we hope to see any improvements? What is the role of the IMF in all of this?
Yeah, thank you, Aditya, for switching to the fintech topic. I think we are in a time of technological revolution in the payment space. And over the next 5 years or so, we will certainly see a vastly different payments landscape, both nationally and internationally. There are 4 dimensions to think about. So one is the emergence of stablecoins. And of course, there are many single currency stablecoins already. There are also multi-currency baskets that are being planned. And it might be that the introduction of stablecoins will have a first-order impact on international transactions. Secondly, many countries around the world are exploring to link up their RTGSs, their real-time gross settlement systems, directly. And RTGSs themselves are undergoing a technological revolution. So many countries are updating their payment systems nationally, and at the same time are working on ways to linking up those payment systems. So that might not work for all countries around the world, but for many countries. Thirdly, of course, the correspondent banking system. The correspondent banking system is quite antiquated. So when anybody does an international transaction today, there's typically your bank here, the correspondent bank of your bank, the correspondent bank of the receiving bank, and the receiving bank. So there are 4 banks in a chain, and every single bank has transaction costs, has compliance costs, has to do AML, CFT checks. And so it's very inefficient and very costly. And so there's a huge opportunity to update the correspondent banking system. And indeed, there are major efforts underway, in particular in the area of remittance payments, to just come up with technologically and legally much more efficient and better systems. Fourth, of course, there could also be some degree of more centralized global payment systems. That is further down the road, perhaps, but it's something where some people are certainly putting some effort in. So there are really 4 complementary avenues where technology is already impacting payments and is going to impact payments much more dramatically going forward. Now, in terms of central bank digital currencies, there are pilots in many countries, and this particular crisis might accelerate the motivation and the speed with which central bank digital currencies are rolled out. And if there are many countries that are adopting central bank digital currencies, that in and of itself will have implications for cross-border payments as well. So let me stop here.
Thank you, Tobias. Let me now turn to CEYLA. CEYLA, you've led the World Bank's response on innovation and finance and supported many projects around the world which are aimed at facilitating transfers, payments, and remittances. And you've also been involved in the bank's response to the COVID-19 crisis. Could you elaborate a bit on the role of digital payments in the COVID-19 response and the broader implications for digital payments going forward?
Sure. So as Tobias also said, the crisis makes it very clear that digital payments are clearly part of the COVID-19 response. The lockdowns and social distancing are making use of physical cash much more difficult. banks have reduced their operating hours, physical agent locations used by mobile money users for cash in and cash out are also affected. This is critical for mobile money networks. We heard from several regulators that in some countries where the migrant workers are, they cannot send remittances abroad because they are not allowed to go out and go to mobile money operators, and sometimes go to money transmitters, and sometimes these offices are even closed. So that for workers that do not have access to digital payments through their phone or other means, it becomes very difficult to really survive during this crisis and help their families who are in their home countries. So this has been also linked with a general hesitation to handle cash due to concerns in terms of potential transmission. So all of this is leading to greater adoption of digital payments in countries by individuals and the governments by governments, where the right services and infrastructure are available. And I'd like to underline where the services and infrastructures are available, as this is not the case, unfortunately, for many countries, hence making it critical that we work on digital connectivity and prerequisites like digital ID and the regulatory legal frameworks that allow the safe use of digital payment services. And that, I think, is an urgent priority. So, and to add to this, there are provision of services like health, education, and commerce that are being widely used through digital means, and digital payments are critical not only for accessing them, but also for the provision of these services, as well as through e-trade and other means which allow people to manage this crisis in a much better manner. So many countries, in many countries, governments are simplifying processes for financial service providers, existing social benefit transfers and social insurance payments recipients, new beneficiaries, and so on. The experience of Brazil is very impressive. The minister was quoting yesterday that within 3 weeks, they were able to digitize, quote unquote, 40 million people. So I think it's, of course, not every country will be able to do this, but it makes it very important that we work on getting more, helping countries as much as possible to switch into safe digital payment systems. So what are we doing at the World Bank to improve the safety, reliability, and efficiency of payment systems and financial market infrastructures? This is a big agenda, as you mentioned, provide financial assistance as well as technical assistance to countries, policy advice on legal foundations, payments infrastructure, and regulatory supervisory issues, working with international standard setters like CPMI and so on, and disseminating this knowledge overall. And specifically, the support includes dealing with regulatory challenges to allow entry of new business models. There are a lot of concerns in terms of trust and in terms of being able to use like cloud services, which a lot of regulators are concerned about, because most of the time these are cross-border and it's not clear that there would be business continuity. Simplifying customer due diligence requirements, interoperability of payment systems, which is really critical for those to access these services, and of course shift to digital large volume payment systems like remittances, government to person payments, and public and private sector salary payments and bill payments. So these are all the work that we have been doing, of course working very closely with many others, partnering with many others on our big initiative ID4D, ID for Development, as well as the foundations, the infrastructure, digital infrastructure with our colleagues in our infrastructure groups to help countries to have these possibilities. Thank you.
Thank you, Jayla, for I think both you and Tobias, you've laid out very clearly the imperative of moving towards systems which are which will enable digital payments as also stores of value. And of course, stable coins are a key means of achieving both objectives. So that now brings me to DIETRICH. DIETRICH, yesterday, or no, day before yesterday, the FSB published a landmark consultation report And just as an aside, I was surfing some of the more geeky fintech websites, and immediately the big headlines were governments to ban all stable coins, which is precisely not what you intend, but is how it's being read in some senses. So obviously your concern is, the FSB's concern is that when global systems, stablecoin ecosystems could become systemically important, and therefore it's important to be able to have them adapt to adopt the appropriate regulatory framework. So what are the actions that should be taken to address the regulatory and supervisory issues with global stablecoins?
So thanks Aditya for introducing this second round of discussion. And I think you mentioned the reception that our consultative report has received in some more of the more tech-oriented parts of the World Wide Web, and therefore I think it may be useful to put the discussion about regulatory and supervisory responses to global stablecoins into context. And the first part of this context is the potential systemic importance that stablecoins may have. The fact that they may become systemically important is one of the main reasons why the G20 mandated the FSB last June, to examine regulatory issues and to advise actually on multilateral responses as appropriate, taking into account, and this is very important, and I'll come back to it later in more detail, the perspective of emerging market and developing economies. So that's one part of the context. I'll come back to that in a minute. Another part of the context is the broader debate about payment system efficiency that you introduced and that Tobias and CEYLA have already talked about. And I think it's important to note, and our report is clear on that global stablecoins have the potential to enhance the efficiency of the provision of financial services. And this argument is probably even more important in the current environment of social distancing, as was mentioned. Now, cross-border retail payments have remained relatively slow and expensive. This is an issue not just for emerging markets, but also for developing economies, but in particular for emerging markets, which face, for instance, the issue of high costs of remittances. I would like to note in the passing that as part of this broader context, enhancing the efficiency of global cross-border payments is a priority on the international policy agenda. The G20 presidency has tasked the FSP to develop a roadmap for how to enhance cross-border payments, and we published also last week, as a first step towards the development of this roadmap, an assessment of the current issues in payments, in international payments. So there's a lot of work going on. And I think the discussion, as I said, about regulatory frameworks needs to be seen in this context. Now, coming back to the systemic question of systemic importance of global stablecoins, I think you can think of this as the flip side of their potentially global use as means of payment and store of value. And more specifically, global stablecoins could pose financial stability risks through a number of channels. The first one is that if a global stablecoin were widely used as common store of value, then even a moderate variation in its value might cause significant changes in users' wealth and therefore trigger significant wealth effects. Second, if a global stablecoin is widely used for payments, any operational disruption might have significant impacts on economic activity and financial system functioning. And then third, the large-scale use of global stablecoins might magnify any confidence effects related to the workings of the stablecoin arrangements. Now, these effects might be of particular importance in emerging and developing economies where households may come to hold large portions of their wealth in global stablecoins rather than local currency instruments. So what could and should regulators do to reap the potential benefits of stablecoins while containing potential risks to financial stability? I mean, this is the essay question behind the consultative report that we published a few days ago. And again, the focus of our report is on regulatory and supervisory issues, not on the whole host of other questions that come with global stablecoins, for instance, about competition, taxation, and so on and so forth. Now, our consultative report includes 10 high-level recommendations to address the regulatory, supervisory, and oversight challenges faced by global stablecoins. I don't want to go through the individual recommendations, but rather make a few quick points on the rationale, if you like, the philosophy behind these recommendations. So 3 points. First, it is important to understand global stablecoins as an ecosystem. That's why we talk about global stablecoin arrangements. And these arrangements include activities that may span across a range of financial activities and correspondingly banking, payment, and security regulatory regimes. So range of functions, range of potentially relevant regulatory regimes. Second point, authorities agree on the need to apply supervisory and oversight capabilities and practices under the principle of same business, same risk, same rules. This is important for 2 reasons. One is obviously a level playing field argument. Another one is to put in place a regulatory framework that is capable to adapt to emerging business models and technologies employed by stablecoin providers. And third, very important, some functions of global stablecoins may have very significant impacts cross borders. So taken together, there is a strong need for a holistic approach to regulation, supervision, and oversight, and close international cooperation and information sharing. And I think these are the, if you like, the underpinnings of the 10 principles. I'm happy to sort of discuss them in more detail in the Q&A part. Yeah, that our recommendations, if you like, spell out 10 key elements of an approach that is based on these underpinnings. I'll stop here, looking forward to the Q&A part.
Thank you, Dietrich, and let me now turn to Ross. Ross, you mentioned the new world order, which is going to be based around a digital economy, and this world may well be one in which many different types of digital currencies may coexist, including central bank digital currencies, cryptocurrencies, and stablecoins. So from all the thinking that we've done, can you share with us what are some of the key legal challenges that lawyers will have to face in this brave new world? And in particular, what are the legal issues which are still remain with regard to the stablecoins that are foremost in your mind?
Sure. Well, first of all, there are many challenges that this brave new world is going to present for lawyers. And I think given that that world is actually evolving, many of these challenges will evolve. You know, generally speaking, neither the law nor lawyers like uncertainty. It makes it difficult for firms to know what the rules are that they have to comply with. And secondly, what rules would apply as they structure their transactions. This basically complicates life for operations on many levels. And you know, with the rise of digital currencies over the past few years, I think lawyers generally have had to advise clients in an environment of uncertainty where the rules may not be entirely clear. And of course, the situation, I think, varies between jurisdiction, where some countries are more advanced on resolving some of these issues than others. And I have to say that a huge amount of work has been done and is being done to try to clarify the legal rules respecting digital currencies generally, but also I think stablecoins specifically. And this work, I think, can be divided into 2 broad areas of the law. The first is the public aspect of the law of regulation. And the second is the private law aspect of the law of commercial relations between private parties. And I think it's not surprising that, you know, earlier on, much of the work was being focused on the first of these 2 buckets, particularly things like anti-money laundering for digital currencies. This was identified as an immediate concern that prompted, I think, a pretty swift response from FATF in trying to develop some standards and guidance for its members around these issues. But I think work is now being done on both fronts, and some progress is being made. But let me maybe share with you some of the principal issues that I think are relevant for digital currencies with particular relevance to stable coins. And some of these issues, maybe starting with the law of regulation, I think DIETRICH has already alluded to some of these, but you know, I think a lot of work is still being done to clarify which legal rules within a regulatory regime apply and where the gaps may exist. And the basic questions is to what extent, you know, a stable coin will constitute money or securities or a collective investment scheme or electronic money or potentially something else entirely. And which regulatory regimes would it fall into? Potentially more than one. In what circumstances does a stablecoin regime constitute a payment system? Does the issuance of a stablecoin implicate banking law? To what extent are a stablecoin regimes subject to, and the service providers involved in them, subject to anti-money laundering rules in a country? And of course, which jurisdictions actually can assert jurisdiction over a stablecoin? You know, these are particularly global stablecoins span multiple jurisdictions with different parts of the regime in different countries and different service providers and users in different countries. How do you reconcile all this from a legal perspective? But beyond these issues of regulation, there is a whole raft of private law issues that need to be addressed. Generally with respect to digital currencies, but I think the list really grows with respect to stablecoins. Many of these I think were identified in the G7 report on stablecoins that was published last fall. And of course, different stablecoin systems, given their different designs, may raise different legal issues. But I'll maybe just, you know, mention a few of them. You know, first of all, you know, what is a stablecoin from a legal perspective? What are the rights of the holder of a stablecoin? And in particular, do they have a proprietary right over the stablecoin, or is it simply a contractual claim between the holder and the issuer of the stablecoin? You know, what are the legal arrangements around the protection of the reserve of assets underlying the value of the stablecoin? What are the rights of a stablecoin holder to actually redeem the stablecoin or to liquidate it, in what circumstances? How can ownership of a stablecoin be transferred between two parties? And I think particularly important, what are the rights of the holder in the event of an insolvency? Does it have a claim on the underlying assets constituting the reserve, protecting the value of the stablecoin? Or does it only have a general claim against the assets of the issuer of the stablecoin? What is the governance structure around the initiative and how are decisions taken? And finally, you know, what rights do holders have over their data when it's held by either the issuer of the stablecoin or service providers? I think, you know, these are just a few of the issues that arise, but I'm sure there are many others, and a lot of work needs to be done to resolve them. I'll stop there.
Thank you, Ross. Thank you, Ross. I think you've raised some very pertinent issues which kind of help us to round off the discussion, starting from as we began with the overall context and coming down to the issue of exactly what are some of the challenges which have to be addressed before stablecoins can be seen as useful means of payments and stores of value and provide the solution to the many of the problems which are being faced in the area of payments and settlements. So we've received some very interesting questions from the audience, and some of them, of course, are beyond the scope of the panel. They are very important and very relevant, but beyond the scope of the panel. For instance, how long do we think the lockdown might last? So I'll leave those out, but I'll pick up those ones which have a little more relevance to direct relevance to the topic today. Not that the others are not important, but those are one which we may not be able to contribute much to the body of knowledge. So let me start with the first question, and feel free to respond to the other questions when your turn comes up. But Tobias, I'm going to go with you first. One of the questions we have is that the scale of this crisis is daunting, and much of the damage could be long-term and structural. Or is it so, or will we snap back very quickly once the vaccine and treatment are discovered?
Yeah, I think so. I mean, this is the crucial question of this crisis. There is a large amount of uncertainty around the medical issues, right? Is there going to be a vaccine? Is the virus going to retreat? Is there going to be a reinfection once people go back to work? Could there be a reinfection in the fall or next year? I mean, these are all questions that are basic medical questions that we don't have a clear answer to yet. Or is there going to be a treatment? So is there going to be either vaccine or some other treatments via drugs, right? I mean, all of these are very unclear at this point, and that is one source of uncertainty. A second source of uncertainty is now that you have these lockdowns to protect lives. I mean, this is what needs to be done. We need to protect lives. What is going to be the economic implication? And of course, this generates a tremendous amount of economic hardship. You know, people can't go to work anymore. A huge fraction of the population around the world has either no savings or very little savings. And many around the world live from their wages to their food, so to say. So they might be facing extremely difficult times due to the lockdowns. And finally, of course, there's scarring, right? I mean, once you shut down the economy, you shut down businesses, you get people unemployed, this can have very long-lasting and very persistent effects. So even if on the medical front, things go unexpectedly well, or somehow, you know, something, somehow this virus is retreating more quickly than expected, you know, the economic implication might be fairly long-lasting. So there's uncertainty about the magnitude and the timing. And then, of course, there's the uncertainty about the financial sector, right? Because as we discussed, banks are well capitalized, they have a lot of liquidity. But if the most adverse scenarios realize, I mean, those, when you look, for example, at the World Economic Outlook, when you look at the adverse scenarios, I mean, those are more severe than pretty much any stress tests that have been run, right? I mean, supervisors over the past decades thought that these adverse scenarios in the stress tests were really severe. And now suddenly we have a crisis where, you know, the baseline is about as severe as the supervisory scenarios, but where the adverse scenario of relative to the current baseline is more severe than what most supervisors around the world have imagined. And so that is going to be another challenge. So there remains a large amount of uncertainty, and this is where policy has to come in, right? I mean, this is precisely why institutions such as the IMF, the World Bank, the FSB, the BIS were created. It's to coordinate policy, to provide firepower, to provide funding to countries that cannot receive funding anywhere else. And, you know, we have seen that to some extent, countries have come together to do the right things. Within countries, policymakers have come together to do the right thing. And my suspicion is that we're going to need a lot more of that going forward, both on the international cooperation front, in terms of taking dramatic actions, and in terms of being courageous to take big policy steps. This is a crisis where you certainly want to hope for the best. I mean, perhaps things turn out better than we expect. And, you know, but we have to prepare for the worst. I mean, we don't want to regret not taking the steps that should have been taken because it is costing lives. So we have to be aggressive. We have to be forceful on the medical front, on the fiscal front, on the monetary front, and of course, in terms of what international organizations are doing.
Thank you, Tobias. And you covered with your response another question which had been raised, which was the one on the lives versus livelihood discussion. And I think you made that very clear. The next question which we've received is a little bit more focused on stablecoins, which is, would the prevalence of stablecoins weaken the power of monetary policy in targeting inflation? And CEYLA, would you like to go on this before I bring it back to Tobias?
Go ahead. Why don't we ask Tobias to go and then
Okay,
I'll go.
perfect.
Okay, it depends a little bit on the design of the stablecoins. So at the fund, we proposed to have stablecoins phased into a regulatory framework of narrow banks. We call that synthetic CBDCs. So that would involve creating a special charter where stablecoin issuers would acquire a very simple banking charter that would allow them to hold the reserves with the central bank. So that has the advantage that, first of all, the stablecoins would be within the regulated banking sector, you know, in a very simple fashion. So this would be these synthetic CBDC issuers would be very, very simple banks. On the asset side, they have central bank reserves. On the liability side, they have CBDCs. That's it. And those synthetic CBDCs could be operated out of banks, out of fintech companies, out of telecom companies. The AML-CFT issues would be resolved in exactly the same way as they're done in the banks, because these would be simple banks. These would be very safe organisms because they hold reserves with the central bank. So this is high-powered money. It's extremely safe. And you could, at that point, you know, it's within the monetary system. So you know how many reserves are corresponding to CBDCs. And you can, in principle, do what China does, which is whenever a CBDC is created, reserves are drained on a one-to-one basis, right? So that you keep monetary control. So I think this is one avenue to go, and it's called synthetic CBDC because it's a two-tier system where, you know, it's private operators, either banks or enterprises are running the synthetic CBDC, which is a stable coin, and the central bank doesn't have to deal directly with the public, which has many problems. So AML-CFT would be done by that bank, but it would have the safety of an institution that is backed by reserves and that is regulated by bank regulators. So I think this proposal of the synthetic CBDCs would address exactly the problem of monetary control. In fact, many countries around the world are expressing interest precisely because they worry that the global stablecoins can undermine monetary control, right? Dollarization is so much simpler once you have in you know, a well-known app that everybody uses, you know, billions of people that can transact across borders. And that can threaten monetary autonomy, right? You can have dollarization, you know, potentially very quickly, and in particular in this period of time where people don't use their homes, everything is done online. This push for dollarization or stablecoinization, so to say, could get very quick and could overwhelm monetary systems. So what many countries are saying is, well, we want to lean against that by developing our own CBDC so that there is a digital currency in domestic currency. And of course, the countries where these digital assets have advanced the most are oftentimes emerging markets or developing countries. So I think it is entirely possible that there will be an acceleration because stablecoins are becoming more popular, but policymakers are also becoming more popular, more aggressive in terms of their policy response because they are worrying about the monetary autonomy. In fact, the IMF is working on a paper for the G20, for the July G20, on exactly that issue.
for outlining this. And I think you brought out the issue of why global stablecoins or stablecoins can become systemic quickly, the point which was being made earlier by DIETRICH. So I'm going to move now to CEYLA, but first I'll give you another CEYLA question for you, which is a twist to the financial inclusion issue, which is, the question is, experience so far indicates that sophisticated investors tend to corner these coins or their benefits. Doesn't this work against the objective of financial inclusion? Could you address this, as well as if you have any follow-up to the questions I asked Tobias? And I'll go around.
Okay, so two issues. One is the whole premise of these innovations is to allow others to be able to access it and make it much less costly and efficient and effective and so on. So I think to the extent that, and many of it, as DIETRICH can explain more, as many of it have to do with the fact that, for example, the cross-border payments are extremely expensive for many. Remittance corridors are not affordable when some people, some migrants or workers, remittance senders have to, give in fees or have to pay fees and other kinds of service fees on their cross-border payments. So it makes it very important that we actually address these issues and see how these stable coins or digital currencies, the way also Tobias described it, can be used in reducing the cost of sending money, receiving money, and so on. And I think this will not just, we're not talking about Bitcoin now, this is not for speculative purposes, this is using digital currencies for much needed cross-border payments and so on. And many countries are also, especially smaller countries which do not have the ability to build these infrastructures on their own, are looking at joining perhaps some regional platforms and systems. So I think that's also an opportunity for many countries to be able to participate. And I think to the extent that we can deal with the risks, and the risks are there, we have to be all cognizant. They include AML, CFT related risks, they include cyber risks, they include financial capabilities and capacity to be able to use such innovations. So to the extent that we are cognizant of those risks and can take measures to address them, I think there is huge potential for increasing financial inclusion through digital payments. We see this in many countries who are actually far ahead of many of the advanced economies, like Kenya comes to mind. Ghana is making a lot of progress in this area. Many Asian countries have made huge progress. So allowing much more efficient and less costly payment systems. And I do not agree that this would be contrary to financial inclusion. If anything, it should help it. But again, we need to really be cognizant of the opportunity, but the risks, and mitigate those risks. Thanks.
Thank you. Thank you very much, Jayla. So let me move next. A question for you, Ross, is that with this pandemic situation and the increasing use of stable coins or fintech in payments, do you think there's already a need to include these fintech-related accounts into the deposit insurance arrangement? You know, we've discussed this before many times, and I'm glad I'm asking you the question and not being asked, having to answer this one.
It's a very difficult question, Aditya, but honestly, I think that it's premature to consider that. I think deposit insurance serves a very specific purpose. And stablecoins, I think, have a broader purpose. And I think we certainly have to put in place a more comprehensive and effective regulatory regime that guards against the risks of that stablecoins may present, as really everyone has commented on. But I think deposit insurance requires probably some more thought.
Thank you, Ross. So I have another question for you, DIETRICH. This is, I don't know if you've had the time to read the new proposal by Libra, because the question is about that. It says, regarding the new proposal of Libra, will some of the requirements or the assessment of the FSB change because of COVID, because privacy concerns could not be the same? If you haven't had a chance to read this proposal so far, which came out, I think, only yesterday, maybe you could respond to some of the other questions. I'll leave it to you.
Yeah, thank you, Aditya. I had a quick look at the revised white paper and the cover letter. I think I would be reluctant to comment on any specific stablecoin-related proposals that concern individual projects, including important ones. I think looking at developments through the lens of our work and our report, as I said before, I think one important consideration for our work was to provide a broad framework in the form of principles that is robust to evolving business models, changes in the external environment, and well, technological innovation, right? So I think there are a couple of interesting points in the revised proposal that relate to some of the principles. I mean, there's a question about the composition of the reserve, the question about that also was alluded to about the claim that the holder of a stable coin actually has. So I think I would see an interesting discussion continuing going forward. I would leave it at that general level if you don't mind. I would rather like to come back to a point that CEYLA was talking about concerning the relationship between innovation in payments and financial inclusion. And I think the really good news is that the issue of enhancing efficiency in payments is firmly on the policy agenda, and I think it is important to consider a number of elements here, not just one model for enhancing cross-border payments, which could be a stablecoin type solution, say, but there are also other ways. Central bank digital currencies have been mentioned, but also there are probably opportunities to enhance, to build on existing cross-border payments arrangements. And I think this is the idea behind the roadmap that we have been asked to develop for the G20 and that I mentioned earlier. Not to provide, if you like, to identify a roadmap for one specific solution, one single way to more efficient payments, but if you like, a route map, right, that charters the territory, lays out what the issues are, and provides elements, technical solutions, legal solutions, regulatory solutions that can be used, that can be combined in a way that takes individual economies, but also on the international basis, the system as a whole, to new solutions. And I think a combination, or if you like, competition between different approaches, I would see that as a good thing.
Thank you. Thank you for that, Dietrich. That's very, very interesting. There have been other questions also on this issue of financial inclusion, financial stability, and the nexus. But one question which I have is now, Tobias, this is on whether the linkage of stable coins to capital outflows. And the question, I think you addressed it a little bit in your remarks, but the question is, the stable coins entail financial risks, especially for emerging economies. Under certain macro financial contexts, the existence of a stable coin linked to a foreign currency, you raised the dollarization issue, might lead to a relatively more volatile demand for assets in the domestic currency, particularly banknotes and bank deposit. This would have some impact on monetary and financial stability. What do you think about this? When there are episodes of nominal and foreign account exchange tension, will this provide an additional channel for capital outflows? And I think you've already responded to this in your question, but if you have any additional view you might want to say it. Let me throw another question at you, which is I think also broadly one for the entire panel, which is, what is your thinking once the fiscal and monetary stimulus, the unprecedented monetary and fiscal stimulus that has been released, when that halts and the unwinding begins, will the global financial system be more vulnerable? And in the post-COVID-19 scenario, what kind of asset classes and institutions may become new sources of fragilities in the financial system? So if you could think about the second one for the panel as a whole to conclude the discussion, but meanwhile, if you had anything else to add on the first one.
Yeah, so let me start with the first one. So on the capital flows and stable coins. So, one interesting question to think about is if a country imposes a capital flow measure, like a capital control, how do you deal with that when there are stable coins? And from what I understand, the stablecoin operators, or those who are planning to be stablecoin operators, would impose those capital controls, right? So the stablecoins are trying not to be a shadow, payment system, but are trying to be part of the regulated and well-governed financial system. So that would mean that those capital controls and capital flow measures would have to be imposed on the stablecoin as well. And so that will be done at the wallet provider level. So basically, wallet provider, so the wallet providers would basically limit. So say country X imposes some capital control, then the wallet provider would limit the outflow, or whatever the measure is. So imagine that country X, limits the extent to which currency can, or any capital can flow out, any payments can flow out. That would have to be imposed at the wallet level, and there would have to be a governance and a legal framework around that, of course, in every single country. And so it's certainly possible to do that. I mean, banks are subject to imposing those, it's certainly desirable, right? I mean, some of the crypto assets, of course, are completely outside of any of that, right? I mean, and some stable coins are attempting to be totally outside of any of this, and they are trying to be in a total parallel world to the current financial system. So there's a deep philosophical divide between alternative stablecoin providers, and you can imagine what regulators are thinking about those alternative approaches. Another issue, of course, that hasn't come up yet are sanctions. I mean, some countries are sanctioned, and in principle, stablecoin providers are also, trying to deal with that, because, of course, if they are transactions with sanctioned countries, they are going to be subject to legal prosecution, etc. So, again, there's a philosophical divide where some stablecoin providers say, I want to be completely away from any of this, while others say, I want to be compatible with the laws and rules and regulations of the international financial system. So let me now move to the second question, which is about this crisis and financial stability in this crisis. And so when you look at yield curves or implied inflation, I mean, last year we put out the Global Financial Stability Report that was called Low for Long. And the theme this year is even lower for even longer. Right? I mean, yield curves are very low, very long, all around the world. I mean, that doesn't mean, of course, some countries are subject to pretty big credit spreads, and they might not benefit as much from those low and long rates. But the benchmark rates around the world, like the US dollar, the euro, the yen, the Swiss franc, etc., I mean, they have very low, very long yield curves. And so monetary policy is going to be in unconventional territory for a long time. So, you know, humans are like to anchor the future in the past. And so they always think that somehow normalization has to come. And I think that is one particular behavioral bias, right? I mean, it's not clear at all that we will go back to the kinds of level of interest rates that we have seen in the past anytime soon. And so that's going to present challenges for monetary policy. Now, moving to the financial stability part, of course, reaching for yield is going to come back, and regulations are important. And I think, if anything, on the bank side, I think, if anything, we might move to even more capital and more liquidity, because now we might see a crisis that is even more severe than the 2008 crisis, right? I mean, in some sense, the post-2008 regulatory reforms were calibrated to a 2008 type event. And we might see something worse, and so we might calibrate it to something even worse. That is one thing. And the second thing I just want to say on the market-based front, I mean, central banks, including the Fed, the Bank of England, the ECB, basically have felt compelled to backstop the entire market-based financial system. And you know, that is going to raise regulatory questions as well. So let me stop here.
Thank you. And may I now turn to CEYLA, and if you could also provide your views on when the waves recede, what will be left standing?
Okay, so I guess we don't know how big the wave will be, so it's a guess. I guess so there are two states of the world, right? We don't know how T+1 will look like. We don't know what will be behavioral changes in terms of consumption patterns, saving patterns. How will the disrupted value chains will be mended? Will there be more protectionism? Potential output is down, is how temporary this will be, and so on. So how we will come out of this is not yet clear, as many of us said during this call. It depends very much on how severe this pandemic continues for, and the impact of the measures. So but what is really clear is that there's no differentiation right now. Everyone is considered as risk, and countries have turned inward. So it's very clear to me that those that come out of this crisis stronger by taking whatever structural reforms are possible. I know this is difficult to talk about at this health emergency, but I think this is going to be, as soon as countries can focus on that, is going to be important. Continuing to strengthen bank resolution, safety nets, and also corporate bankruptcy frameworks, because I think we started this crisis. We have a book out which is Global Waves of Debt, and the cover is like a tsunami. This was before the pandemic. This was published in December, and we are already at record level of sovereign and corporate indebtedness. So it's obvious that we will have corporate insolvencies, and hopefully it won't be systemic. But the more prepared we are to deal with these potential failures, I think the better off countries will be. So really looking at out-of-court settlement systems, all the types of measures we took after other crises where we face systemic bankruptcies, I think will be critical. Hopefully they will end up being drawer plans, but I am afraid for some countries they won't be. So the more we can prepare, the stronger countries will hopefully emerge from this crisis.
Thank you, CEYLA. And may I ask DIETRICH now for his views?
Yeah, thank you, Aditya. 3 quick points on, well, what will be left standing. First, role of buffers. I think we've seen over the past couple of weeks how important it is to have buffers available that can be used when they are needed. And it's good that we are using the flexibility that is provided by international standards in terms of using buffers. However, looking ahead at some point, in order to have buffers available down the road, there will have to be rebuilt and replenished. And I think this is something to bear in mind, that we need to look beyond, at some point, beyond the current crisis, and also bear in mind the need to rebuild buffers. And I think this is also reflected in our principles, that we are not going to roll back with the policy responses on existing agreed regulation, but we are using the flexibility that exists in order to preserve financial stability going forward. Second point, quickly on non-bank financial intermediation, Tobias was referring to it. The FSB chair wrote in his letter to the G20 that the impact of COVID-19 on credit markets and investment funds has highlighted potential vulnerabilities in the increasingly important non-bank financial intermediation sector, and that it's important, more important than ever, to understand the risks and ensure that we can reap the benefits of this dynamic part of the financial system without creating risks for financial stability. And the FSB has formed a senior group of market regulators and macroprudential policymakers. Tobias is also on that group, to develop a proposal on how to organize work on this important area in the FSB going forward. Last point, important to look ahead, not lose sight of the fact that there will be a world after COVID-19, and therefore it is important to continue on initiatives that can support and hopefully will support a strong recovery. And therefore I'm very grateful that we have this focus on innovation in payment systems and stablecoins. There are other areas of work that need to continue, harnessing the benefits of technological innovation more generally. Assessing the effects of reforms is important. Promoting efficient and resilient cross-border payment system we talked about, and from an FSB perspective, last but not least, also supporting a smooth transition away from LIBOR remains an important issue. I'll stop here. Thank you.
Thank you, Dietrich. Ross, the last word.
Thank you, Aditya. I'll be very brief. I think one thing that will be left standing will be a global financial and payments landscape that will continue to evolve and I think move towards greater digitization. And I think to ensure that this process is a force for good, it's critical that the public sector, particularly central banks, stand at its center to ensure that the system that evolves is not only stable and efficient, but also inclusive. And this will involve, I think, central banks being directly involved in innovation, but also the public sector ensuring that regulation is in place that protects the financial system and the people participating in it. And I think that the nature of regulation may change in this context. I think Tobias just pointed to a fascinating example of capital controls, where new types of service providers involved in digital payments will have to exercise some oversight over the purpose for which transfers of digital currencies and stablecoins will be made. You know, historically in countries, this has been a very paper-based process involving banks and other types of traditional service providers. What will it look like in a digital world involving new types of service providers? I think this will involve a great deal, I think, of imagination, hard work, and creativity on the part of the public sector working with the private sector. I'll stop there.
Thank you, Ross. And I think you very aptly summed up the discussions. So I can just add very little to the wrap up. In a sense, what I think we all recognize, and there's a consensus here, that digital payments are front and center in many ways of the COVID-19 response, as we have seen in the way the governments are reaching out to with their various means and methods of transfers and payments. And this could well determine the winners and losers. It's the point which you made, Ross, about what's left standing will be the payment, those which are very well integrated with the digital system. This could well determine the winners and losers in the new world, and it will be an urgent priority for everyone to catch up in a certain sense. And global stable coins, as we discussed, they provide a very useful means of addressing these issues, but many risks, as pointed out by all of you, still need to be addressed. And as was pointed out, there are deep philosophical design differences which dictate design issues and application issues, which also have to be very well understood. Else, they may well end up causing the next distress in the financial sector. So with that, let me just first quickly thank the Toronto Centre for the excellent work that they have done in bringing this panel together. They do it every spring and annual meetings. We are very grateful to them for the legwork that they do. Let me also mention that this proceedings are recorded and will be available for those of you who want to see it. Finally, there were some questions which I could not come to, some which are very important and interesting, and we will see if through Toronto Centre we can reach out and respond to some of those questions. But finally, and for everybody, please join me in a virtual applause for the fantastic panel that we have had today. Thank you.
Thanks very much, Aditya, and thanks, Toronto Centre.
Thank you. Thank you, everybody.
Thank
Bye-bye.
you, everyone.
Thank you, Aditya.
Thank you very much.
Bye. Have a good day.
Thank you.
Bye.
Okay, bye.